The journey, from a small seed of capital to a substantial sum, is often misread. People imagine a rapid acceleration, a straight line, pointing sharply toward abundance. They overlook the dense wilderness of volatility and the sheer, grinding effort required. $100 feels insignificant to the wealthy, yet it is the entire world to the struggling trader. This small amount demands reverence. It must be treated not as disposable money, but as sacred trust. We start with $100, treating it as the foundational stone of an empire built on precision, not fortune. The critical first step is recognizing that this capital must survive long enough to even encounter opportunity. Most fail here, extinguishing their future through reckless sizing, right at the beginning. They mistake hope for preparation and velocity for actual progress. True growth requires a profound commitment to preservation, above all else. The market is a colossal machine, designed to extract liquidity from the impatient and the disorganized. It tests the mental reserves and the rigidity of one's approach. With ruthless efficiency, your small capital provides excellent tuition, forcing you to learn economy of movement and patience. If you cannot manage the small weights, the heavier ones will certainly crush you, swiftly. Success is found in minimizing necessary errors, not eliminating all risk. The desire for immediate wealth is the sharpest enemy of the burgeoning account. This craving forces overly large positions, relative to the starting stake, guaranteeing painful, swift endings. We must cultivate a deep respect for the time required for compounding to take hold, naturally. Think not of yesterday's gains, but of ensuring tomorrow's participation remains viable. The pursuit of quick riches yields only exhaustion and empty screens. The true path is not spectacular, it is slow, deliberate, and sometimes unbearably quiet. It involves long periods of inaction, waiting for the clarity that justifies placing capital at risk. Understanding the market's true rhythm saves both money and mental energy over months and years. Small wins, carefully protected, accumulate into the critical mass needed for scaling. This is the quiet, essential reality of the low capital climb. We define the acceptable threshold of pain immediately, establishing the firm boundary of retreat before the conflict begins. The stop loss is not merely an order in the system, it is a vow made to your future self. It represents the point where the original hypothesis is definitively invalidated by market action. Honoring this vow protects the bulk of the account from inevitable periods of directional confusion. When trading a $100 account, the size of your loss must be minute, almost imperceptible. Each failure should remove only enough capital to register the mistake, without threatening ongoing survival. This tiny loss teaches you the necessity of tight spatial awareness. Within the price action, you must learn to demand immediate validation from the market. For every conviction trade placed, the goal in these early stages is achieving durability, the ability to withstand 20 or 30 consecutive failed ideas without fatal injury. Most traders start with insufficient armor for such continuous engagement. They allocate too much faith to a single entry, allowing it to define their entire account's standing. Durability is the secret weapon of the survivor. In the long game of markets, consider the $100 capital as raw potential energy, waiting for the right structure to emerge. You are searching for moments where the imbalance of supply and demand is undeniably evident. Avoid the choppy, indecisive zones where larger players efficiently grind away smaller accounts. Precision and selection is the only hedge available when resources are scarce. The market often presents situations that appear perfectly set up, yet these often serve as elaborate traps. The structure must align with the necessary risk tolerance, dictated by your minuscule account size. If the necessary stop distance compromises the survival threshold, the setup must be discarded immediately. The ideal opportunity is one that grants both high conviction and tightly contained risk. Our focus shifts now to liquidity, the magnetic forces that pull price towards specific price levels. We must identify the zones where orders cluster, where the market is certain to find fuel for its next major move. These concentrations of pending transactions represent the areas of maximum probable pain for the majority of participants. Understanding where pain resides is crucial for positioning. Smart money seeks to capitalize on the predictable placement of stop losses by the crowd. This means observing where the retail trader has placed their boundaries of defeat, Anticipating the sweep, the market often moves against the consensus, just long enough to collect this liquidity. Before resuming its true direction, we aim to enter. After the cleanup operation has finished its destructive work, identify the regions where aggressive entry attempts have failed, leaving behind clear evidence of trapped positions. These areas become magnets, because the trapped participants will eventually be forced to liquidate their holdings. This forced liquidation provides the necessary momentum for the move we wish to capture. Patience allows us to witness these painful liquidity events unfold. Every significant move is fueled by the destruction of a previous structure that held false hope for many. Learn to see the price charts not as lines, but as maps of human commitment and eventual betrayal. We are not predicting the future. We are observing the present distribution of pressure and anticipating the inevitable release. This detachment elevates decision-making above hopeful wishing. The concept of pain zones is highly powerful. These are price areas where a large volume of forced selling or buying must occur. Recognizing these zones allows for superior entry points, far from the chaotic center of activity. We position ourselves quietly on the periphery, waiting for the predictable stampede toward forced exit. The market is merely harvesting inefficiency through volatility. Once we identify a potential setup, the entry must be surgical, demanding immediate affirmation of the analysis. There is little room for float or temporary adverse movement. In a low-capital environment, a trade that immediately draws against the entry suggests a misreading of the short-term pressure dynamics. We seek to capture the moment. Momentum begins, not the moments preceding its initiation. If the price lingers near our entry, failing to accelerate into the anticipated direction, exit should be considered immediately. Waiting for the full stop loss to be triggered often consumes too much limited capital, unnecessarily. Small scratches, tiny losses taken early, preserve the integrity of the account. For truly advantageous setups, protect the capital base fiercely from unnecessary erosion. The definition of a quality trade is one where the risk required to define the failure is significantly smaller than the potential reward. This imbalance is the structural advantage we seek, relentlessly, in every session. If the required stop distance makes the subsequent gain proportionally trivial, the opportunity is fundamentally lacking. Demand asymmetry. In every single deployed position, we focus on achieving high-quality hits, allowing the market to prove our conviction quickly, or disqualify it efficiently. This approach minimizes exposure to time-based decay and unexpected reversals, typical of holding too long. The $100 account cannot absorb the costs associated with prolonged positional uncertainty. Sharp entries and efficient exits define the early growth curve. Trading is essentially an exercise in highly specialized waiting, punctuated by brief moments of decisive action. The vast majority of market time should be spent in detailed observation and precise planning. Only a few moments, per day, or per week, justify deploying the limited capital base. Patience is not passive. It is an intensely active form of analytical observation. As the account begins to grow, perhaps reaching $200 or $300, the psychological pressure subtly shifts. The initial gains feel precious, making the thought of giving them back terrifyingly real. This is where many traders falter, tightening their stops prematurely, or refusing to trade setups that require slightly larger commitments. The fear of loss often paralyzes the willingness to grow. The core framework of defining defeat before entry must remain absolutely rigid. Regardless of account size progression, you must adjust your position size incrementally, ensuring the absolute monetary loss remains within the comfort zone. This comfort zone is defined by the size that allows undisturbed sleep every single night. If sleep is interrupted, the size is fundamentally wrong. Scaling up must be performed with profound respect for the mental weight of larger positions. A $5 loss on $100 feels different than a $50 loss on $1,000, even if the percentages are maintained. The absolute monetary value begins to engage deeper fears about preservation and security. Acknowledge this shift, but refuse to let it interfere with technical decision-making. Increase position size only when the current scale feels completely routine and devoid of associated emotional distress. This incremental increase must be earned through sustained execution efficiency. Over time, If a larger trade introduces hesitation or panic, revert immediately to the previous size that felt effortless. Consistency trumps all desires for rapid acceleration. The objective is to maintain psychological neutrality across varying trade sizes, treating $100 wins and $1,000 wins identically, in terms of execution. This is achieved by focusing solely on the structural integrity of the trade setup, detached from the outcome's monetary value. The execution must become a mechanical act of honoring the plan, regardless of capital involvement. Every system faces unavoidable drawdowns, periods where a sequence of losses systematically erodes capital gains. The ability to navigate these inevitable troughs, without abandoning the methodology, is the ultimate test of resilience. Drawdowns are not failures of ability, but structural necessities. In any probabilistic endeavor, they must be anticipated and managed without surprise. Prepare for the psychological challenge of watching hard-won profits vanish through a series of minor defeats. This requires an almost cold detachment from the temporary P&L swings. Your focus must remain anchored to the long-term integrity of the strategy, not the fleeting results of the last hour. Enduring the pain is necessary to reach the next plateau. The market sometimes forces you to endure trades that move significantly against you before reversing powerfully into profit. These are the deep test zones, requiring unshakable commitment to the defined stop level. If the analysis remains sound and the stop has not been reached, the position must be held with quiet conviction. Many surrender their winning trades during these intense internal battles. The true measure of a trader is not found in the size of their largest win, but in the composure maintained during the deepest drawdown. This is where the foundation of initial preparation proves its worth. Under duress, if the rules break down during stress, the initial framework was inherently too fragile for true market engagement. Strength is proven in the storm. Learning to sit quietly through adverse fluctuation is a sophisticated skill, demanding trust in the defined boundary of defeat. Knowing the worst possible outcome is already contained liberates the mind to focus on execution. If you continuously move the stop-loss or exit prematurely due to discomfort, you betray the foundational compact of self-control. We transition now from internal management to external dynamics, the necessary aggression required for true growth. NICCOLò Machiavelli, in The Prince, suggests that successful rulers must understand when caution yields to necessary force. Trading, too, requires understanding when maximum force should be deployed against structural inefficiency. Like the successful ruler, the trader must know the precise moment to abandon neutrality and commit fully to a direction. Hesitation costs money and opportunity, leaving the trader stuck in the ineffective middle ground. Once the structural setup is confirmed and validated, the deployment of capital must be decisive and unapologetic. Machiavelli's lesson on anticipating fortune applies perfectly. We cannot control the market's movement, only the preparedness of our defenses. We build dikes and defenses during calm market conditions, ensuring resilience when volatility inevitably strikes. Preparation limits the market's power to surprise and dismantle our established order. The market respects only strength, the strength derived from consistency, not from brute force capital. It senses the desperation of the ill-prepared and targets their vulnerability efficiently. We must project an impenetrable front, defined by rigorous adherence to calculated risk levels. This commitment to structure becomes our strategic defense. The trader must cultivate virtue, a blend of ambition, skill, and sheer willpower, to impose their strategy upon the chaos. This does not mean forcing price, but imposing methodological order upon personal conduct. We control the entry, the exit, and the size. The rest is merely the market revealing its present truth. Understanding how orders are matched and processed illuminates the mechanical heart of price movement. Every candle movement is the visible result of large participants filling significant orders against the available liquidity. We observe the market not for direction, but for the footprints of massive capital engagement. When large institutions enter or exit, they often require multiple transactions executed across a range of prices. This volume leaves traceable evidence on the charts, indicating where supply or demand absorption is strongest. We seek to position ourselves alongside these major participants, benefiting from their required directional thrust. The market will revisit price zones where large amounts of volume were previously traded, acting as a gravitational anchor. These areas represent price acceptance, where both buyers and sellers were temporarily satisfied with the exchange rate. Subsequent tests of these levels often determine the market's near-term structural integrity. We must differentiate between genuine commitment volume and noise, the random fluctuations driven by smaller participants. True commitments appear as significant spikes in volume, accompanied by large price displacements. Filtering out the noise allows us to focus on the movements that actually reshape the underlying market balance. Identifying where the large players have left their residual orders provides the clearest pathway for anticipating future movement. These orders, placed to manage risk or secure scale, act like hidden waypoints for the price. Our strategy leverages the fact that large capital needs time and price range to complete its mission. As the capital base grows toward $1,000, the focus shifts entirely from survival to structured reproduction of quality setups. The account is now large enough to withstand minor turbulence without inducing immediate panic. This is the transition point where trading moves from frantic execution to measured business operation. The early, intense focus on microscopic movements can now broaden slightly to encompass wider timeframes and larger structures. This provides a clearer view of the dominant trends and reduces susceptibility to short-term market noise. We trade the confirmed structure, not the fleeting moment. The Prince by NICCOLÒ Machiavelli is a timeless classic of political strategy, one that perfectly mirrors the mindset and tactics required to survive in the financial markets. Just as a ruler must act decisively, conceal intentions, and use fear as a tool, a trader must enter with precision, manage risk, and separate emotion from execution. This book isn't just about power. It's about the cold logic every market participant must master to navigate chaos. Study rulers to better understand money. The link to the book is in the description below. Growth acceleration requires compounding the gains efficiently, systematically increasing position size in controlled increments. Each successful cycle earns the right to deploy slightly more capital in the next instance. This disciplined scaling prevents overextension while utilizing the growing capital base effectively. The achievement of $1,000 confirms the initial methodology is viable and proves the capacity for self-management under pressure. It is a milestone, not an arrival point, demanding renewed commitment to rigorous execution standards. Complacency at this level is the fastest route back to the beginning. Treat the capital as infinitely divisible and easily replaceable within the defined risk parameters. Attachment to the dollar value hinders flexibility and introduces fear into the necessary process of shedding losing positions. The capital is merely a tool, and tools must be utilized efficiently or discarded when broken. The path to $10,000 requires replicating the foundational principles established at the $100 level, but with larger numbers. The rules governing position sizing, stop placement, and trade selection remain inviolable. The psychological battle intensifies as the weight of the potential losses becomes palpably real. Maintain complete internal equilibrium when executing a trade that could potentially result in a significant monetary loss. The maximum defined loss must be mentally accepted before the order is even placed into the market. This pre-acceptance shields the decision-making process from reactive panic. When price moves against you, the temptation to chase profits or deviate from established parameters becomes most acute. When the account is expanding rapidly, rapid growth often breeds overconfidence, leading to reckless abandonment of established protective barriers. Guard against the ego that whispers promises of impossible certainty. To reach $10,000 requires consistency in execution across numerous market cycles, avoiding catastrophic losses that reset the journey. One single, Undisciplined trade can erase weeks or months of diligent compounding efforts. The protection of capital remains the highest managerial priority, always. View the $10,000 goal not as a reward, but as the minimum functional capital base necessary for true professional engagement. This amount allows for diversification, robust risk management, and meaningful deployment of capital in various instruments. It represents freedom from the suffocating pressure of small stakes trading. Mastery in trading is defined by the absolute alignment between the intended strategy and the executed action. In the heat of the moment, there should be no gap between intellectual understanding and practical deployment of orders. This seamless execution requires immense mental preparation and rehearsal. The refined trader possesses a deep understanding of their own psychological failure points and proactively constructs defenses against them. If impatience is a known weakness, the system design must incorporate longer time frames that enforce necessary waiting. Self-awareness precedes effective execution. The market constantly broadcasts deceptive signals designed to encourage premature commitment or unwarranted fear. The developed trader learns to filter this noise, relying only on the confirmed structural elements of their chosen methodology. Indifference to market chatter is a sign of operational maturity. Every successful trade reinforces the fidelity of the plan, building quiet confidence in the overall system's validity over time. Conversely, every failed trade offers critical data regarding the plan's limitations or necessary refinements. Both outcomes are valuable and must be processed without emotional judgment. The ultimate success is achieving complete sovereignty over your own decision-making process, detached from external expectations or fleeting market whims. The trader becomes a closed system, executing mechanical decisions based purely on defined parameters. This is the quiet power of consistency. Liquidity hunting becomes an art form, anticipating the precise price level where the maximum number of participants will be forced to exit their positions. This predictive capacity is built through relentless observation of volume clusters and defined structural breakpoints. We are observers of market necessity. The market often moves toward zones of maximum inefficiency to correct imbalances created by overextension or speculative bubbles. Positioning ahead of these corrective movements yields the most asymmetric profit opportunities. Look for structures that appear fundamentally unsustainable. Consider the concept of the weighted average position held by the market crowd, and position yourself opposite to its point of highest comfort. When everyone feels comfortable and validated by current price, the reversal is often imminent and violent. Comfort is a precursor to disappointment. True skill involves maintaining objectivity when the market confirms your position, avoiding the euphoria that leads to holding too long. It also requires objectivity when the market challenges your position, avoiding the panic that leads to premature exit. Emotional neutrality is operational currency. The journey from $100 to $10,000 is fundamentally a transformation of the individual, not merely an accrual of capital. You shed old habits of haste and fear, replacing them with patience and surgical precision. The capital growth is merely a side effect of personal evolution. The market environment never offers guarantees, only the presentation of opportunities that satisfy pre-established conditions. Success is defined by the meticulous application of the known framework to the unpredictable reality. Maintain humility regarding the limits of market knowledge. Even at $10,000, the size of the required loss must still feel trivial relative to the total account value and future potential. Never allow any single trade, regardless of conviction, to jeopardize the established solvency threshold. Preservation remains the enduring law. Reflect on the initial necessity of treating $100 with profound respect. That same reverence must be extended to the growing $10,000. Larger capital demands greater prudence and more stringent adherence to risk control principles. The potential for major loss increases with scale. The focus shifts now toward generating sustainable income and managing the increased complexity of larger account management. The psychological burden transitions from fear of failure to the pressure of performance maintenance. This new stage requires deeper strategic oversight The true journey was not the acquisition of $10,000, it was the construction of the self capable of surviving and growing through market adversity. This structure, the operational self, is the most valuable asset you have acquired. Guard it. Refine it. And understand. The work is never truly finished.